I'm sure you're going to hear more examples of climate solutions in this next session that will explore how insurance can help reduce financial risks, ensure economic stability, and promote sustainable practices that benefit both insurers and communities. The speakers will also delve into the role of nature-based solutions, as I said, highlighting innovative approaches that integrate natural systems to enhance resilience and mitigate risk. The folks coming out? Okay. Well, I'm going to say their names. So I'm very pleased to introduce the moderator, Frank Tomasello, the Executive Director of the Institute's Griffith Insurance Education Foundation. Our panelists are Superintendent Beth Dwyer of the Rhode Island Department of Business Regulation, Lars Powell, the Director of the Alabama Center for Insurance Information and Research at the University of Alabama, Natalie Enclave, the Executive Director of Build Strong America, and Russell Stack, the Director of Catastrophe Analytics at Aon. So thank you very much.
Thank you. It's a pleasure to be here. It's a pleasure to share the floor with these outstanding thought leaders today. Together, we'll explore the role of insurance in risk-based mitigation and resilience, and consider the role of nature-based solutions over the next 40 minutes or so. This morning, Susan Winkler, during her opening remarks, spoke of the increasing frequency and severity of losses due to climate issues. And Commissioner Mays talked a bit about the power of collaboration to address these existential threats. To begin our conversation this afternoon, panelists, may I call upon you to spend just a couple of minutes to speak to the current climate risk landscape, and perhaps to the importance of using a variety of tools in the risk management toolbox, as it were, to meet the moment. Lars, would you care to kick things off?
Well, as a recovering risk management professor, I love to hear myself talk and can't think of a better thing to talk about. So yeah, I'm happy to. Thank you, Frank, for the invitation to be here and talk about this important topic. So we've got these several risk management tools, as you say, in our toolbox. And a lot of them would be really bad for these climate risks. Things like separation, diversification, duplication. Everybody can't have two houses to live in or two buildings to work in. So we're left with some of the more obscure ones, at least from the way we teach it in class, because I've always taught in a business school and we can't teach how to build anything except a portfolio. So we can do pre-loss mitigation, meaning we can build better buildings. We've got a lot of evidence that that works well. We've got some new stuff hot on the press that if we have time I'll talk about later from Hurricane Sally. But I think from the nature of the question, the answer is we can invest in information. That's what we've been doing in Alabama, along with all of the creative things that we've tried. An insurance company can't do anything with the information until they can believe it and they can quantify it and they can measure it. And so it's important when you're thinking about risk management is you've got to have all the information you can have. You've got to know, well, we think if we build up this coral reef as a nature-based solution that it will reduce the expected frequency and severity of flooding and or hurricane wind risk. But we don't know that until we've measured it, and that's an investment in information. It's one of my favorite risk management approaches, risk management tools, is this investment in information. But it's something that every insurance company can participate in. We know that you do it in behind closed doors, and to the extent you can help us with it, then that's great. But yeah, it has to be, the information has to be there before we can start implementing these things.
Thank you, Lars. Panelists, care to add any color to what Lars just shared?
I think, first off, thank you for having me here. I think just to build on that, I mean, information is extremely important, and being from the CAP modeling side, we're able to take some of that information and start quantifying it. So as being able to bring in this information, such as, you know, if you do the coral reef or you build a more fortified structure, like how does that get into the models? Can we actually model that and show that benefit? That is going to be extremely important as well. So.
From the Build Strong perspective, we started as a building code coalition, and then as climate started becoming a much bigger topic and we started recognizing that, we have to throw all the tools that we possibly can into our toolbox and throw it at climate. So it's not just building codes anymore, it's expanded. It is these public-private partnerships. So to echo Lars and Russ, we need to pool all of our resources. So take everything we possibly can, throw it at the situation, to link, leverage, and align to get to ensure that it's a coordinated approach. So I would just add that as well too.
Thank you, Natalie. Superintendent?
So from the regulator's approach, of course, we're not the people doing the experiments or modeling, but we do feel that we have a duty to get out information to consumers. And we were talking at lunch about how frustrating it is to try to do that. How do we get consumers to understand how this would benefit them? I do recall about 15 years ago in Rhode Island when we were discussing risk mitigation, we heard, well, why should we benefit the insurance company? Why should we do something that makes their loss less? Well, you need to realize, you know, if you're that unfortunate person whose home is destroyed, you might have alternative living in your driveway for a year. That's not pleasant. You know, it's not all that just because the insurance company is there and you have a policy that covers it, that you will not suffer harm. So how do we get that across, and how do we encourage people to mitigate and understand what the mitigation means?
Thank you. I'd like to spend some time exploring, we heard a little bit about CAD modeling and risk assessment and consumer education, and rest assured we'll devote some time to explore those topics. Before we do, perhaps we can drill down a bit on specific risk-based mitigation and resilience projects that insurers might invest in, and how might those projects impact financial risk exposure. Anyone care to take the lead there and share some thoughts?
You know I will, but go ahead.
Go for it.
So the hard part about this, especially talking about when an insurance company is going to invest in one of these sort of public projects, is you don't have anything to bind the policyholder to the insurance company. So if you do something to strengthen a policyholder's home and then they move to another insurance company next year, it hasn't done you any good. So we've seen the North Carolina JUA, their wind pool, do some of this because the folks on the Outer Banks are sort of stuck. But and also the wind pool's job is to put themselves out of business. But from these other things, I think the one avenue you have where insurance companies can participate is insurance companies are some of the largest investors in municipal bonds. And so my favorite nature-based solution for wildfire is to put a municipal golf course between neighborhoods or between the WUI area and a large densely populated area. So issuing bonds to build that golf course or park or softball field, having a big open area as a fire break is a really good idea for places that are struggling with wildfire risk. And to the extent that an insurance company would be purchasing those bonds, there's some argument to be made that there might be some concession in the price if it's going to reduce the overall risk. Again, if I wouldn't be standing up here saying that if I worked for an insurance company, probably, but I think that there's that discussion to be had.
And you know, in recognition of what Lars says, we need to thank Alabama for their strength in Alabama homes, and I think more and more you're going to see states adopting a similar approach, where the state is getting the money to the homeowner to make the house more resilient, because you're absolutely right, the next year it might be a different insurance company. And we actually have some data now with Alabama, having done it for a number of years, and I think with more and more states coming on board, we'll have more and more data. Alabama was not the only state. My understanding was Louisiana and Florida both had the program but didn't have the funding. So the funding is absolutely critical. And through the NAIC, the state insurance regulators are really encouraging funding from the federal government, appropriate tax treatment of funding that we get through, programs like Strengthen Alabama Homes. And, then getting out to the consumer, why is this important? How does it benefit you? And how is this funding assisting you in making your roof more resilient in this part of the country or wildfire risk? I actually had my roof done about 4 years ago, and we had been discussing tape, which is a very cheap, not expensive, and it does have a lot of, and I asked the roofer, and he literally didn't know what I was talking about. And the reason he didn't know what I was talking about is it wasn't in the Rhode Island Building Code. It was in the Connecticut Building Code, but the roofer in Rhode Island is not going to learn it unless it's of no value to him. He's going to walk up to me and talk about tape if I don't know what he's talking about. So, building codes are so important. If you get it in there, the vendor is going to understand what it is. So someone like me who's unusual and asks, but he couldn't do it for me because he didn't know what I was talking about.
Natalie, I see your head nodding, and given your area of expertise, please, appreciate your gloss here.
I was just thinking about my own personal story with my HOA, how they're about to replace all of our roofs because of end of life, and I was asking, oh, well, can you just allow us to pay the difference for a fortified roof? And they told me that was a scam by the insurance industry. And my mind was blown, so, yes. So, anyway, so investing in resilience and how insurers can reduce claims, kind of on this same path. The insurance industry does invest in many programs, so Wildfire Prepared Home at IBHS, specifically out in California. I think I saw Commissioner Lara out here. They're doing great work out there. But for me, listening to this morning's panel, public awareness campaigns, I think, is something that we really need to invest in. I'm a former FEMA person, and to hear the lack of knowledge around flood not being in a homeowner's policy was really interesting to me. Where it rains, it can flood. And so that's something that would be great if we can invest in that a little bit more. But yeah, and workforce development, of course. So also the insurance industry invest in Build Strong America, where we are investing in workforce development through a Build Strong Academy. So.
I think I just want to echo a lot of what was said here. I mean, education is something that's drastically needed. Having come into the industry with no insurance background at all about 12, 13 years ago, I had very little knowledge about flood policies and any of that sense. And it's extremely important. I mean, now I get to tell family members, like, why don't you have a flood policy? Why don't you have an earthquake policy? Those are all extremely damaging perils for them that they wouldn't have any knowledge on. They would think the regular insurance policy would cover it. In terms of like insurance and natural-based kind of mitigation, I think being able to have some of that defensible space, so going back to the golf course analogy, that does provide that buffer, and I would hope that insurance companies can start building that into their rating plans. You have these if you have a buffer, you have this mitigation in place, whether you're closing off eaves, you have a buffer, you have even ice plant around your property. That's a wildfire mitigation, just sticking on the wildfire example. All those, if it can be transferable, and I think that goes back to codes and rating agencies, making sure that's put into the books so that insurance companies need to follow it and have a way to quantify and provide that premium discount.
Yeah, going back to Lars's point and Rose's point here, we need to invest more in research on how do we put nature-based solutions more into CAT modeling, because that's been a challenge for the industry.
And we accept that money.
Let's shift gears a little bit. The insurance industry possesses expertise in risk management in many ways, but risk assessment and modeling are a couple of areas of great expertise within the industry. How can that expertise be leveraged to enhance the effectiveness of resilience projects? That's an area I'd like to explore with the panel. Perhaps a good place to start is maybe to ask you to speak to the state of risk assessment tools and modeling approaches employed by the industry. Russ, can I call upon you to maybe kick that off? And it may be helpful for some folks, perhaps in the audience, to maybe appreciate a little bit about sort of the history and the evolution of modeling, so that we have some context in terms of where we are today.
I'll do my best to do justice to that. So modeling in the early stages was relatively crude. Didn't do, there wasn't a lot of science in the back end. There wasn't a lot of vulnerability. So when I talk vulnerability, like what type of structure, there was just base sets that you could look at. So results obviously were very high level. I think you can argue today it's much more detailed. There's a lot more money invested by modeling firms to actually do large studies. We call it a black box, but they do have a large scientific team that are figuring out the hazards. They work with engineers so that they can understand the vulnerability. Nothing's perfect. I think being a model, it's wrong inherently, but at the same time, it does provide a very valuable set of data and information. Outside of the models, if you want to get model agnostic, you can go into hazard scores. So this is understanding the hazard. This is something that is used in the underwriting process, which I think can also be merged into understanding where could we do nature-based solutions. In high hazard areas that can identify like, hey, we need to do the golf course, or we know that there's a high flood hazard here outside of what FEMA designates. That's where you could start looking at different types of flood projects to help mitigate those types of impacts. And then kind of evolving from that, you now have climate models. So going into the climate change aspect, at Aon we have a climate risk monitor that helps aggregate some of that data and give you some portfolio level analytics on different perils that are kind of in the climate change realm. And then also to build on that point, a lot of the modeling firms are now starting to invest a lot of money into the climate change. So you're getting what's called climate condition curves, to where they're trying to forecast out 30, 40, 50 years to understand what could this loss look like.
Thank you, Russ. Appreciate that. Thoughts from other panelists? Anyone care to piggyback there?
Sure.
Lars, I'm stunned that you...
Yeah, well, I'd
Okay.
like to hear myself speak. I'm sorry. Data. Insurance companies have lots of it, and the rest of us have very little. Many of the questions that we'd like to answer, we don't have the data to answer. I understand why some insurers don't like to share their data. We recently did a data call from Hurricane Sally in Alabama. Commissioner Fowler made that happen, and now we have a wealth of information on how these different technologies work, and we're going to be able to get as specific as how old is your roof before it starts to perform worse, and the specific wind speeds that are affecting different types of homes, and it seems like that would already be very well known, but it's not. Some of it's in a bit of a black box with fair risk and RMS models, but some of it is just it's right there, and we aren't permitted to look at it. So I don't know if it's worth still asking the insurance companies to share data as much as asking the regulators to work with your local universities or with my university or anybody that's qualified to do it, and get the data in and process it so that we can understand some real answers to big questions.
Thank you, Lars.
So I couldn't agree with that more. I don't know if we can give you any data, but getting the data and understanding what is actually happening as opposed to making assumptions, that's the way we're actually going to move the needle. Through the NAIC insurance regulators, we have to understand these models. Very few of us have the education or background to do it ourselves. So the Center for Insurance Policy Research has put together the Catastrophic Modeling Center of Excellence. And the purpose there is to have people who do understand the models that we can go to for explanations. 15, 20 years ago, of course, my state is essentially all coast. And so we started seeing some of these effects of insurers wanting to leave coastal areas. And so there were two modeling companies out there back then, and it was RMS and I can't remember the other one. And this was unhelpful. Insurers were coming before our legislature, and their answer to why our insurance premiums going up was, oh, the reinsurers are using models. It's all the reinsurers' fault. And I understand that it's easy to put it off on someone else. No one wants to be the center. But what that meant was the legislature then said, oh, okay, so we'll put something in law that you can't use that model. That's not an answer. That's understanding why the model is saying what it's saying and how that's affecting things is the answer. And so that's what we're trying to do with CIPR, so that we'll have the information when our governors, when our public policy people, when our legislature want the information.
Thank you, Superintendent. Russ, anything to add? I don't know if I thought I saw a head bob there, so didn't want to exclude you.
Modeler.
Superintendent, if I may, to kind of follow up, this may be a good opportunity to speak a little bit and obtain your thoughts maybe a bit further on this balance between innovation in the form of enhanced CAT modeling, right, and the need to understand what's in the black box, as it were, and to balance that with the interest of consumers, right? A delicate balance for sure. Appreciate any further thoughts you have there. I think that's a topic of, I would imagine, of interest to many in our audience.
Yeah, so we're always frustrated as regulators when we get calls from consumers and we can't get an explanation for them of where the rate is coming from. That is very important in insurance. If you think about insurance as beneficial to the conversation, it's giving the signals. So if you have a red Corvette and 9 accidents, you're going to pay more for your auto insurance. The signal it's giving you is stop getting in accidents and don't buy a red Corvette. We need the same thing in homeowners. We need homeowners to understand resilience measures that they have taken have assisted, but you still have a risk because you live in Newport, Rhode Island on the water. And aren't you lucky to live in Newport, Rhode Island on the water? So we really do need to be able to explain to consumers where rate increases are coming from, how their rate is made, and some of our frustration has been the black box. And some insurers, and I'm not saying all, you'll go to them on a specific consumer and say, well, if I don't give you precisely the exact amount, you're going to fine me. I have never gone to an insurer to get an information for a consumer in an attempt to fine you. That has never been my motivation. It's always been the motivation to get the information to consumers. And I've never encountered another regulator who wasn't really just trying to get information. If we can give general understandings, 30% of your rate increase was attributable to an overall rate increase. 10% was, whatever it's attributable to. It will give people the type of information that they can utilize to hopefully take actions to make themselves safer. Someone mentioned Bermuda earlier, and they just got hit, direct hit, by a hurricane, and virtually no damage. I was talking to someone from Bermuda, he said almost nothing, because they've built to it. They know they have the risk, and they have built to that risk. And how can we get there in the United States to get people to build to the risk and lower our overall damage from these catastrophes?
I think education is extremely important in this realm. I mean, I have the fortunate ability to understand typically where some of these price increases are happening on my own insurance. And I love talking to the agents, asking them like, so what's going on? Why is this happening? Kind of already have an idea. But that's where, the reinsurance comes in. And lately, there's been so much cat loss that reinsurance costs have gone through the roof, which is cutting down on the insurance's bottom line, which means then they have to go out and raise rates and kind of build back what they've been paying out. So having the consumers fully aware of why things are moving rather than just saying, oh, it's up 20% this year, and it was up 20% last year, like, so what's going on? That kind of black hole of transparency, I guess you could say, is really painful to the consumer.
Yeah,
And just to throw this in, the consumer thinks that the insurers are making money hand over fist right now, and they're just not. It's that positivity bias that this is not going to happen to me. And so that's why we just have a problem with building stronger, not being more resilient just generally. So to help with those premiums, driving them down.
Speaking of some education, these numbers are hot off the press. They're preliminary, but from our data call, I can tell you that compared to standard homes, the fortified gold houses in Hurricane Sally had 36% less loss severity. That's among homes that had a claim. The claim was 36% lower. For fortified roof, it was 27% lower in severity. For loss frequency, gold fortified compared to standard was 65% less loss frequency. 65% less loss frequency. That's enormous. And then for roof, it was 48% less loss frequency. Those are numbers from the last storm, looking at 50,000 policies that had 10,000 claims, and there were 9,600 fortified homes in the path. So included in those. That's a legitimately credible, if we've got any actuaries in the room, it's a credible sample. And we've still got some things to do to refine it, but the loss ratio, taking into consideration premiums, the loss ratio for fortified gold was 55% lower than that for traditional houses, and for roof it was 47% lower. That's with the mandated benchmark discounts we have in place, meaning maybe those discounts could be a little bigger. So I feel like all the news is very positive in terms of we've figured this thing out, and we just need for everyone else to understand it and be confident in using it. There's plenty of caveats that go with that, so I'm not saying that this paper's ready to be published. I got the data day before yesterday, and I've been furiously scrambling over it for a while, but those are the top level numbers, and they won't change. We'll be looking at where the wind was stronger and where you were closer to the coast and some things like that. But overall, you know, those are big numbers from a large sample.
Lars, thank you for sharing the preliminary figures with us. Very, very encouraging, and maybe a good segue into some discussion around what incentives insurers might offer policyholders to encourage participation in risk-based mitigation and resilience efforts. Sort of open that up to the floor here. We touched upon a couple of things here in conversation already, but anyone care to jump in and maybe delve a bit more deeply?
I'll start. I think this is where our state-based regulation of insurance really excels, because it really varies depending on where you live. So while New England, or maybe even southern New England, has very specific roof tie-downs, hurricane shutters, a few other things, that is not going to be what you're going to do in California. They're not having a hurricane. So we would love more data about how efficient these mitigation efforts are. And most of the statutes that I've seen that set up something similar to Alabama Safe Homes actually rank, or list the types of mitigation efforts you should encourage by where you are. CIPR also has a great pamphlet on state resilience efforts that lists by category of threat, so tornado, hurricane, wildfire, what are the risk mitigation efforts that would have the most, bang for your buck?
And CIPR, I'm working with them as well on a white paper and best practices for setting discounts based on fortified. We've hired the modeling firms to model it a bunch of different ways, and then we're just going through the whole process of what we did in Alabama back in 2015 or 16 or 14, whenever it was that we were able to get those benchmark rates set. There's a lot of decisions you have to make, and we want to make this document's going to explain how we approach each one of them and the different things you might do based on how your state is similar to or different from Alabama.
Natalie Russ.
Yeah, I'll jump in. Other than premium discounts, which everybody wants and is chomping at the bit to get, providing grants on financial support for the mitigation programs, kind of like Safe Alabama Homes, right?
Strengthen Alabama.
Strengthen Alabama Homes, providing those funding for those grant programs, which, by the way, I know we're not talking politics, but there is a retrofit pilot that will be signed into law this year, so that's exciting. Look for that to come. Possibly endorsements for resilience upgrades. And if anybody can figure out how to work with HOAs, trying to get them on board with it, that would be a huge incentive for me at least. But.
Yeah, I think sticking with the modeling side for me, would obviously premium discounts, as you mentioned, everyone wants to get those. But finding a way to kind of implement that into the modeling so that that can be captured for when they go to get reinsurance, and that cost can come down and then feed through to everyone else. Because it is a business for them, so they got to be able to make money, but also they got to be able to serve their employees, their customers. So.
Thank you. If we step back a pace or two, perhaps we can talk for just a couple of minutes about how significant you believe risk-based mitigation and resilience projects to be with respect to long-term economic stability. So sort of stepping back, panning out with a wider lens, what will that mean long-term for the stability of communities? Anyone care to opine a little bit further? Obviously, we've talked about this. There was some discussion earlier today on this topic as well, but given the comments about consumer education that we've had, I wonder, are folks perhaps fully aware of that impact?
This comes up a lot in western Alabama, where we have the distinction of the most expensive tornado in the history of recorded tornadoes. It dug a ditch about a mile wide from Tuscaloosa to Birmingham in 2011, and it was terrible. But we're also an economy that depends on manufacturing, and do you really want to put your new Toyota plant in front of where you might have a tornado like that come through, or hurricanes? There are some things that have to be built on the coast, and so they have a lot of questions about where are our employees going to live after this storm. We run 3 shifts at the Austell military plant in Mobile, Alabama, and if there's a storm, then their people are going to stay home and keep their family safe and do these other things. So I know that Walmart won't do business with anyone that doesn't have a backup plan if they live in a hazard area. I remember that came up with one of the companies when I lived there, and they had to actually buy a secondary office in case a tornado or something, or an earthquake hit their primary office, and this was their dental insurance provider. It wasn't like that. This wasn't a brick and mortar thing, but they didn't have a plan, and so we got together and said, well, this is the best place you could put it so that one event won't destroy both buildings. So it's a huge economic development thing. When you've got inexpensive non-union labor, sometimes you can get around those things, but everybody's at a disadvantage that has any sort of natural hazard that could take your workforce away.
I think in terms of like a community being more resilient, I think there's a lot of cost savings across the board, whether that's with the community itself and the insureds within that community, as well as to the insurer, because the more resilient a community is, the less likely, if there is some sort of an event, that you're going to have longer business interruption, for example. That's a huge cost to an insurance company. So a more resilient community should theoretically bounce back quicker, which will hopefully help mitigate a lot of those other costs. So if you can educate a community on being more resilient, as well as getting the insurance companies to kind of recognize that, I think there's actually a benefit all around there.
You know, we've discussed the lack of take-up of flood insurance, as did the prior panel. And, you know, as Connecticut just experienced, Vermont has had a number of floods. There isn't the insurance backup there. So when a community is hit by a flood, you don't have the take-up of flood insurance is 4%, that's not going to really help your community. In Rhode Island's our tagline on our license plates is the ocean state. I've been trying to get that changed so no one will notice, but our largest flood event was a rainstorm, a rain event. Connecticut's also with huge coastal exposure just had a rain event. The former South Carolina commissioner used to say, do you need flood insurance? Does it rain at your house? You need flood insurance. But communities, so until we get to that point where flood is included in your main policy or there is more of a take-up, it's incredibly important for the resilience of the community to just be able to come back from a disaster like that.
Yeah, absolutely. So I echo everything, but also on a grander nationwide scale, it reduces disaster recovery costs and gets us back rebounding quicker. We've all heard the study. I would hope we've all heard for every $1 we save 6. That can go up from every $1 we can save up to 11. If we go above code for critical infrastructure, 18. But yeah, it gets us back. Job creation, economic growth, property value. Lars has a wonderful study on that. And then definitely just getting us, the more that we're able to build stronger, drives down that disaster costs for the taxpayers just generally across the board. So,
Thanks, Natalie. I should take a moment to remind folks that they may submit questions using the Slido app. I should also confess before this body that Commissioner Fowler set the bar very high in terms of the use of the iPad to view Slido questions. He also referenced his request for an 8th grader to assist. He did not need that. If that 8th grader has been identified, though, well, I'm open to that assistance, just for the record. But we'll take a few minutes here to cover some of those questions here shortly. We've explored a number of concepts that offer great promise for the insurance ecosystem. And I thought we might turn for a moment or two to the other side of the coin and talk a little bit about some of the challenges that we're facing in terms of promoting and implementing risk-based mitigation and resilience projects. Perhaps we can spend a couple of minutes on that before we think about opportunities to address those challenges, which is also important. Who would care to dive in there?
I'm happy to hop into this. Going back to my former FEMA days as the Director of Individual and Community Preparedness, it is definitely, people do not think anything is going to happen to them. We used to run the National Household Survey, and about 56% of the country would respond that they believe they would be impacted by a disaster. The most interesting of that was after COVID, 76% thought they would be impacted by a disaster. And whether you believe whatever about COVID, you were still quarantined, so you were impacted by this disaster or event. So it is definitely people just have this positivity bias. It's not going to happen to me. The best quote was from Amanda Ripley's book, The Unthinkable. If you have not read it, you absolutely need to read it. It is fantastic. It is why people behave the way they do in a disaster. The most deaths, and I'm going to botch this quote, but the most deaths in Hurricane Katrina were caused by Hurricane Camille because people survived Hurricane Camille and they did not think they needed to evacuate in Hurricane Katrina. So it is absolutely, it's not going to happen to us.
So we have that problem in southern New England because we really haven't been hit by a hurricane. So we have huge hurricane risk, but our last hurricane was Hurricane Bob in 1991, and that was Category 1. And honestly, there was a little bit of damage, but nobody remembers Hurricane Carol in 1954. The vast majority of people were not alive, and that was a Category 4 or 5. People died. 1938 was the same. We have the risk. But the average person is like, well, it wasn't in my experience. If I don't experience, I don't believe it can happen. And how do we get over that? I'm somewhat, I think it's more in the media now that disasters are getting worse and we should be I am also the banking regulator in Rhode Island, and early on when I moved into banking, because I'm really insurance background, I kept hearing from the lenders, well, they don't need flood insurance. So, that to the consumer is that somehow you're covered, as opposed to you don't need to buy it for your mortgage. So that kind of misinformation, if we could figure out a way to get away from that kind of misinformation and let people know that there really is a risk out there, I think it might be able to move the needle.
I would talk about the difficulty in spending FEMA funds when you've had a loss and there's pre-loss mitigation funding allocated. At least, maybe it's just Alabama, but we have these ideas that, oh, let's do this, that, or the other to prevent losses next time. And by the time you've finished all the paperwork and it's 3.5, 4 years later, and they're like, okay, we got to spend this money. You're like, now what were we going to do again, and why were we going to do it? And there's been turnover at the mayor's office, and they're not willing to put the 25% match in. We could speed that up a little bit. I don't mean we, I mean FEMA, people in Washington, D.C. I know this isn't, speed and efficiency is not what you're known for, but 3.5 years to fill out a form and get some money back is a long time. And I know that the rules tend to change on the fly as there's turnover in each FEMA division. This is not a terribly hard problem to solve, and it's tens of millions of dollars just in Alabama that we don't get to allocate towards these things. And more so than that is the being able to evaluate these projects, to have a way to evaluate them objectively, as opposed to saying, well, if we had a levee right there, we wouldn't have had that flood. That might not be your best option today, even though that was what happened most recently. So there's a new tool called NCORE that I've been telling people about in side chats, but it's at Colorado State University. They've spent about $25 million developing this over the last 10 years. You can go to their website. It's free. Now, that takes a little bit of a heavy lift. It's not for the faint of nerd to get started, but it does a lot of the same things that the catastrophe models do once you build up your location you want to study. So we're very interested in that. I just learned about it a couple weeks ago and got an account, and we're trying to make that work for us so we can evaluate these. Every single state, every municipality has these projects they'd like to do for mitigation the next time there's a disaster declared, but how do they rank them? This is all very hard to do, and there are some really good tools that people have come up with for doing that.
Thank you, Russ. Your thoughts in terms of challenges and then also opportunities or positive initiatives overcoming those?
I think, again, I mean, I've been a big fan of the education part for insurance companies to get that down to the policyholder, but just interesting hearing about the Northeast. I constantly see portfolios with very high losses, and the models see the risk in the Northeast because there have been those events. We say they're in the tail because they're way high up, like at 1 in 200 year event or 1 in 500 year event, so really higher, less likelihood of it to happen. But as with the last panel, they were talking about how with climate change you might start seeing some of those further north. So the quicker we can get the education to the consumer, then hopefully they can start fortifying and being able to better ride out these types of storms that will inevitably likely come. So.
Thank you all.
Can I say
Yes,
one
Natalie.
more point? Yes, one more plug. And being from New Orleans, it's hard to say this, but Alabama is the gold standard for with the Alabama Resiliency Council on how the
Point at Mark Fowler, don't point at me.
Mr. Mark Fowler and the Alabama Emergency Management Agency work together and sit as co-chairs on this council because the FEMA money goes to the Emergency Management Agency, and then the insurance commissioner is obviously in charge of the insurance and the risk management. So it is a perfect example, and if you don't have that, you need to have that, even though Alabama Emergency Manager is hoarding the building code money. So.
Thank you.
Cold dead finger.
Let's delve into a little bit of Q&A here in the time that remains. And to get things started, let me ask, what, if anything, can we learn from concepts that have been implemented in other parts of the world? And Superintendent Dwyer, perhaps we could kick that your way to begin with, if you don't mind.
Sure. So the International Association of Insurance Supervisors, which we participate in, every single state in the United States is a member, has a climate task force, of which I was the vice chair. Grace Arnold from Minnesota took over for me last year. But they have a recent paper that they issued. But I spent quite a bit of time listening to people from around the world. The chair was from Singapore, and I'm from Rhode Island. We're 12 hours away. But it's surprisingly similar. I mean, many jurisdictions have these issues. One thing that I think is talked about a lot more internationally than we talk about is parametric insurance. And I think that's because the penetration of insurance is not very high in areas like Indonesia, some of the areas around like Vietnam. So I hear a lot of people talking about, well, parametric insurance for the small farmer who in a typhoon is wiped out and needs the amount to plant the next year. That, to me, is an interesting concept that hasn't really gone that far in the United States, but maybe it could. We have a lot of hurricane deductibles in Rhode Island. It's 5%, up to 5% of coverage A. Nobody is going to expect their $25,000 deductible. Is there a parametric product that could be paired with a regular homeowner's policy so that risk is a bit mitigated? So there's a lot of interesting concepts around the world, and that's why we continue to participate. We have NAIC staff that do it, and people from the various states to try to pick up some of these ideas and see what is working.
Thank
Other
you,
places also
Superintendent.
build better houses.
Like Bermuda.
Bermuda, China. If you live at the coast, it's mandated in a lot of places that you build a house that they don't have to come back and fix. And the complaint I hear is, yeah, but you start doing that now and it'll be 20, 30 years before you ever get any good out of it. Well, we started a little over 10 years ago in Alabama, and now the area where we're about to celebrate our 50,000th fortified home, there's only about 240,000 single-family houses in that area. And that's in 10 years. There's been some development, but it's a substantial percentage of the houses now. Just because you've got to start somewhere. Yeah, it might be 2% every year just from naturally re-roofing houses. But if you don't start, you never finish.
Thank you. Natalie, Russ, anything to add here?
I don't have too much on the international front. I know if you want to go into climate risk, we have a global team that is constantly looking in that realm, but in terms of specific projects.
Thank you. We are nearly out of time. I'm going to try and sneak two more Q&A items in here. First, going to innovative distribution models. A member of our audience asks, how do you think innovative distribution models like group purchased cat insurance fit into solving these protection gap challenges? Anyone care to jump in there?
I love this one.
I got nothing.
Well, this is what we call this in insurance nerd speak. This is the Bourse equilibrium. Can we get the right amount of capital deployed to each exposure unit? And the estimates say that we could be 20 to 30% more efficient in the U.S. insurance industry, but you can't make anybody do that because it's everybody making choices in how much they're willing to insure. But yes, the system could be more efficient if it were distributed differently. I'd love to hear a great idea about how to actually make that happen. I've heard of a product called spread strips, where you take houses from a lot of different places and you securitize them from the ground up, but you can't write against it as reinsurance. It's more complicated than I have 2 minutes and 12 seconds to go into, but come ask me about it. I think it'd work really well, but I don't know how you implement it.
Thank you, Lars.
I think from the regulator's perspective, there's not a bad idea, as long as the consumer is getting value and we understand how the insurance is being delivered. I think we need new ideas. I mean, people buy homeowners policies because their lender requires them to. That's not the reason you should be buying it. You should be understanding the policy. So is there another way? Is there a group plan that value what you're buying. I don't have an answer. I just know that it's probably something we should explore.
We are nearly out of time, so a lightning round question for all here. Looking ahead 5 years, what will the risk-based mitigation and resilience landscape look like? So we're asking you to gaze into the crystal ball. Perhaps we can just head right on down the line and start with you, Superintendent, if you like.
So I haven't mentioned this yet, but we have a lot of risk mitigation tools we use in our financial surveillance of insurers. And we really expect that the insurers are looking at this. So we're looking at it in our risk-focused financial analysis, in our examinations. We expect it in the ORSAs. We expect that insurers, we're more monitoring you. We're a regulator, not a, but we're expecting a lot from the industry in the next 5 years. And we've seen so much in the last 5 years. I can't predict what it's going to be, but I'm excited to see it.
Nothing will change. I don't have any confidence in people.
Ever optimist. I'm not as pessimistic as Lars, but
I'm just neutral.
I think, especially with FEMA, I guess our insurer of last resort, the disaster relief fund keeps bankrupting. We're on our 2nd year in a row. Something has to change, and resilience is it's now a bigger topic every year. So I think we're not going to be we'll be a little bit further than Lars thinks, but something has to change as far as insurance and the way that disaster costs keep rising.
I'll be a bit more optimistic. I think there will be some change. There's definitely been movement, as you can see in Alabama. So, I mean, that's a positive outcome. I think in the modeling firm and trying to quantify the risk, there's been a lot more research and a lot more, we call them secondary modifiers. So some of those, hurricane shutters and things like that, there's more different mitigation factors that they've been looking at that hopefully gets incorporated into models and be able to quantify that.
Thank you. We are out of time. It's been a fascinating conversation. Superintendent Dwyer, Lars Powell, Natalie and Claude, Russell Stack, thank you very much for being with me.
Thank you.
Thank you.
Thank you.